Hello guys, welcome to a presentation on liquidity runs and liquidity pools. This is lesson 7 of the course, module 1 of our course, and we're going to be discussing liquidity pools today and also liquidity runs. So before I go into, as usual, we always start with the concept of liquidity in market. So now let's define liquidity from an institutional perspective. Liquidity refers to the degree to which a market, which is an asset or a security, can be quickly bought or sold in the market without affecting that asset's price. When we look at price, we're looking at where existing orders will reside in the marketplace. Now, I think it was about 2 days ago, I did a lesson on liquidity, and I talked about the varying types of liquidity, where we talk about engineered liquidity, neutralizing open flow, discussing open flow liquidity. So what we're going to do is we're going to delve in detail into those concepts of what liquidity is, and then we're going to talk about liquidity runs and also liquidity pools. Before we start with liquidity runs, we have to first define liquidity pools. What are liquidity pools? Now, liquidity pools are not something you can detect in the marketplace. It's not something that you can go into the marketplace and say, oh, this is where we have a liquidity pool. Okay, what we define as liquidity pools are what we call implied liquidity pools. Okay, because we cannot physically see the orders. Only individuals who have access to this are the central banks. No one else has access to this information. So what we do on the chart is, it's not that we know for sure that orders are there. All we are doing is we are implying that orders should be there based off of market delivery. Now the question is, what type of orders will rest around levels, and where do liquidity pools form, or what are the areas in price where we have a pooling of liquidity? So these are questions we're going to answer today, and we're going to delve into on today's lesson. So first, we're going to define the two types of liquidity we have. Okay, we have two types of liquidity in the marketplace, and it's based off of market delivery. We have buy side liquidity and we have sell side liquidity. Those are the two types of liquidity of interest to us as institutional traders: buy side and sell side. Because the only two things, or the only two directions the market is going to move, is either up or down. It's not moving anywhere else. Market is either going up or the market is going down. Okay, so that creates buy side liquidity and sell side liquidity. Now I'm going to define this conceptually, and we're going to talk about this. So first off, we're going to use a notation. So let's assume we have the market make a short-term high up here, and it starts to decline. We see pressure lower into a discount array. Okay, that discount array, we see a bounce away from there. We have this. Now what's going to happen here is sellers who are selling inside this range, they're going to have protective buy stops above this high. Why is that going to be protective buy stops? So let's think about this conceptually. If you're selling, your sell order is a market execution to sell the asset. That's what your sell. When you click that sell button on your M24 or your M25 or your laptop, or your desktop, your trading station, that sell order is a market execution to sell at that price. Your stop loss. So let's do this hypothetically. Let's say you sold this out here. You're targeting some discount rate down here, and you have your stops above the high of this range. Alright, so your execution is a market order to sell the market with whatever lot size or contract you're using. Your stop loss is a buy limit order to buy at a premium, okay, or at a loss. So when you sell, if the market goes against you, your stop loss becomes a market execution buy, meaning you're buying back your sold position, but this time at a loss. Okay, so it is sell, market execution sell, This is a buy limit order. Okay. This is also a buy limit order. If the market trades lower to your target, how do you exit the market? When you take profits, that is a market execution to buy. So your sell position is a buy limit order up here. Okay. And your target or your take profit, that's also buy limit order, but to buy back your position at a discount. That's how you make a profit. All right. So your buy limit order here constitute what we call buy sell liquidity pool. Why is that buy sell liquidity pool? Buy sell liquidity pool, or what I call implied, because we cannot see the orders physically. It is implied, but that's buy sell liquidity pool. That's buy sell liquidity pool because there is available and willing transactions out there for buyers. Okay, so we have willing buyers up there. That creates a buy sell liquidity pool. So think about this: if the market, if you sell short there, you have your stops above the side up here, and there are also individuals who want to buy the breakout of this range. So they're waiting for market trade up there, and you have the pending buy sub order there, and the market trades up into that. Their buy sub order gets triggered to go long. So essentially, we're talking about breakout traders. Okay, so traders will trade breakouts. You're gonna have a buy sub orders there. So now we have the protective stops of sellers inside this range, and we have pending buy limit orders of buyers, of willing buyers above the high of this range. So by looking at price, we can imply that there is an availability of willing buyers up here, which is what creates a buy sell liquidity pool. So that buy sell liquidity pool is a hybrid of both the stops of sellers and the limit orders of buyers, of willing buyers up here. So if the market drives up there, then we are essentially driven up into a level of buy sell liquidity. So meaning any individual who is accumulating a discount, if we can drive the market up there, then they have a level where there can be counterparty to their transactions. So if you're buying down here and you're exiting at this high here, then you need counterparty liquidity to exit your transaction. Okay, so if we have individuals who are buying down here at discount, okay, the algo will want to drive the market up to a level where they can offset their accumulated positions, or they can offset your longs against the willing buyers in the marketplace. And those willing buyers are going to be in form of buy stuff from sellers and buy limit orders. Buy limit orders from sellers and buy sub orders from willing buyers above the short-term high. That's how you get a buy sell liquidity pool. And then the same concept also applies for a sell sell liquidity pool. So with a sell sell liquidity pool, let's assume that the market makes a short-term high and breaks above this high here. Okay, so we're going to have individuals thinking this is a breaking structure, and let's assume that we still have an item from discount the market is not traded down into. They're going to look at this as a breaking structure, and they're either going to go long at the breakout of the short-term high, or they're going to be buying the retracement, expecting the next leg higher. So this is for market structure traders. And at the same time, there's also individuals who want to follow the trend, or what we call trend following. They want to sell the breakout of the run below this short-term low. So that creates a pull in the sell side from individuals who are going along here. So you're executing a market to buy. Their stops becomes a sell limit order to sell their bought positions at a loss. If the market goes up to take profit, that becomes a sell limit order, okay, to sell their positions at a profit. That buy position, it becomes a sell limit order to sell their positions at a profit. Okay, so if the market can drive down below this low here, all the longs or all the buyers inside this run here, they become a counterparty to any individual who's shorting this run above the short-term high. all the willing sellers down here, okay, they also become counterparty liquidity to all the individuals or waiting for the markets to run below the slope here to sell. Okay, so any individual who is shorting here, their target is going to be an area where they can buy back their positions at a discounted price in profit. So who is going to take on the opposing side of their bought positions? Down here is going to be all the winning sellers in front of the buys inside the screen with their sell stops, with their with your sell stops. There's also going to be all the willing sellers here with their sell stop orders. So it's going to be all the buyers inside this range with their sellable orders and all the sellers inside this range with their sell stop orders. That creates collectively what we call sell side liquidity pool. So now you understand why we call a short term high a buy side liquidity pool and a short term low a sell side liquidity pool, because it creates a hybrid of a one-sided transaction. Okay, so if we can drive to these areas of liquidity, then we can facilitate counterparty transactions, meaning we're either pairing up orders, we're squaring positions, we're mitigating positions, or we are reaccumulating or redistributing in alignment with order flow. Now that we've defined the two types of liquidity we have in the marketplace, let's go into subtopics on liquidity, and we're going to start with different topics. So I'm going to outline the topics we need to cover today. Alright, so on today's lesson, we're going to be talking about voids of liquidity. We're also going to be talking about injecting liquidity. We're going to be talking about pools of liquidity, neutralizing open float, neutralizing pending float, number 6, engineering liquidity. Number 7, we're going to talk about controlling the board. Alright, so these are topics we need to discuss. We have number 1, voids of liquidity, number 2, injecting liquidity, number 3, pools of liquidity, and number 4, neutralizing open flow. So now let's talk about voids of liquidity. There's going to be periods in price whereby means of lopsided order flow creates porous gaps in price. What happens is when we start price delivery, you're going to see that price delivery is highly inefficient. And when I say highly inefficient, I mean it is characterized by inefficiencies, liquidity voids, imbalances, all those sort of things. They're clearly defined in that run higher or lower. Okay, so that creates voids of liquidity when the market is coming from a level of stable flows of liquidity or a range. Okay, so when I say stable flows of liquidity or liquidity base, that essentially means a consolidation or a range, because a consolidation is essentially where we building orders or building positions in the marketplace. These first price actions are highly inefficient, and they are a result of thin liquidity, and these voids in liquidity will be revisited at a later time. So the algo will remember these voids of liquidity and will revisit it. So whenever you see impulse price swings that are highly inefficient, which is typical of impulse price swings, you oftentimes will see a return back down into the base preceding that impulse price swing. So I'm going to show you conceptually, and then we're going to go into detail on this. So we have a consolidation here, which is a liquidity base or stable flows of liquidity in price. And then a trigger comes into the marketplace, which is in form of a large order coming into the marketplace that triggers the algo to start a profit release phase. Okay, so I call this a profit release phase. Essentially, the algo starts to drive higher, but in process of the algo driving higher, it's doing so inefficiently. Okay, and you see a lot of inefficiencies in price, maybe volume balances, regular balances, bullish fair value gaps, BISs, those type of inefficiencies in price in a run away from a liquidity base. Those are what we call voids in liquidity, or liquidity voids. Now, when the market runs into a level of premium where there can be short-term distribution from the orders down here, the algo will seek to retrace back into an area of fair valuation, which we talked about, the previous lessons we talked about. Okay, so what the market is doing is the market is going back in to fill in all the liquidity voids, and then you see a retracement like this. The market returns back down into the base of liquidity, which is that initial consolidation. Now, more specifically, the order block preceding the expansion, and then the market starts all over again. It starts to run higher, and sometimes you can do so efficiently too. And this initial run higher, that is what we call voids of liquidity, because the delivery higher was highly inefficient. So we have what we call thin liquidity in the run higher. We have thin liquidity in the run higher. Okay, so that is a highly inefficient price delivery mechanism, and the algo will seek to re-deliver into all those areas of price action, okay, for efficiency fill. And then oftentimes it will return back down into the base of liquidity, which is going to be the order block preceding expansion, and then starts to rally. Now remember, an order block is also an area of stable flows of liquidity. That's also liquidity base. Okay, so we're going to do this. We're going to get rid of all of this and go into live price action example to describe this. So let's get rid of all of this. Alright, so let's look at a chart of Bitcoin on the 1 hour time frame. Now if you look at this run higher on Bitcoin to this liquidity up here, it was highly inefficient. We had a highly inefficient run Bitcoin. So this run higher is a void of liquidity, because we have thin liquidity in the marketplace to get up into this level of buy side liquidity. Why? There are individuals who are accumulating down here. They are accumulating as we run below short-term sell side liquidity. Who is accumulating? Institutions. They're being counterparty to sellers, willing sellers down below the short-term low. So if the sellers are shorting, institutions will buy against those sellers, acting as counterpart of liquidity. And then the algo starts to displace, trades back down here, displaces a little bit more, trades back down here. So you can see how the initial displacement is, it's not like this. Okay, it's very efficient. Alright, so every time we displace, the market returns back down into an area of a liquidity base, which is a bullish order block here. Displacement returns back to liquidity base, and then here building in a range consolidation, we're building a consolidation, and then the moment we run a short-term liquidity or short-term sell stop, where institutions can be counterparty to any individual shorting this run below this low here, the algo starts to aggressively drive up into a level where all the longs here can be distributed against the willing buyers up here. So they are counterparty to individuals or long down here. So this run higher, look at how inefficient the run is. Very inefficient. You can see we have a BC here, we have a bullish fair value gap here, we have a volume balance here, we have a smaller bullish fair value gap here, and then we have the final BC up here. And then look at what the market does. The market returns back down into our base of liquidity. What's the base of liquidity? Order block prior to expansion. That's where we're trading back down. So now eventually we traded lower because the bias is weaker and the market is running for sell stops. Like I said, we'll return back down into our liquidity base. And what we're doing, the process of us returning back down into all of this price action is what we'll call redelivery. Okay, so I'm going to write this out. That is that's redelivery. So we are redelivering back down into an area of balance or an area of efficiency here. Alright, so we're going to get this off. And next up, we're going to talk about injecting liquidity. Okay, so what is injecting liquidity in price? Injecting liquidity in the marketplace simply is a market aggressively running for liquidity after a build up of orders. That's where you get the classic false head and shoulders, false trend lines, false momentum indicator confirmations. Okay, all of those are all utilized to building one side of liquidity in the marketplace. So let's look for a very good example here. Alright, we're going to look for a very good example here. I'm going to use this to define. Oh, sorry. We're going to use this to define the concept we're talking about today. If you saw this high up here, does that look like a top to you? Is that a top information to you? Why? Because that is a double top. Okay, now granted, this traded a little bit higher, but your relative equalized up there. That's what the classic textbook teaches you as a top. And they tell you to sell the neckline of that double top, which is this here. Because it's all patterns. That's what retail knows. Patterns. Head and shoulders. Momentum indicator confirmations. Trendline confirmations. It's all patterns, and the algo uses this against them. Now, it's not like they're going to the marketplace and looking for patterns. Okay, it's just classic price action creates a general pulling of liquidity like this, and you have a pulling of buy stop. After the accumulation at discount is done, liquidity will be injected into the marketplace in the form of voids in liquidity, because the algo is drawing price aggressively to a level where there is pending liquidity, or what we call pending open float liquidity. So what is open float liquidity? Open float liquidity is the pre-existing liquidity or the current liquidity in the marketplace. That's what we call open float liquidity. Open float, meaning liquidity currently in play. That's open float liquidity. So injecting liquidity also ties into neutralizing open float liquidity. I think I probably typed in this twice. So typed in neutralizing open float liquidity. This is supposed to be neutralizing pending float liquidity, not open float liquidity. Okay. So neutralizing open flow liquidity ties into injecting liquidity. Okay, because what happens here is the idea of a resistance in price is sold to retail, and retail buys the idea of a resistance in price, and that causes them to take actions based off of what they're seeing in price. Okay, and once they've seen that, liquidity is injected into the marketplace via this aggressive run higher for buy stop. Also, if you look at this, you're relatively equal. They're clean lows. So if you were looking at this and you're following the textbooks, they teach you that this is resistance. This is support, and this should hold price. Well, let's see if it actually holds price. Does it hold price? No, it does not. See how the market slams down third. Okay, slams down third a little bit, acts like it wants to trade higher, so everyone thinks that is support again, and slams right through. So all the individuals who are buying this here as support, you're gonna have sell stops resting below this low here. So the market injects liquidity into the marketplace, okay, and it runs for the sell stop. Question you're asking yourself right now is, who is retail? Retail are individuals like you and I who are trading off of our MT4s. The funds, they also fall under retail. Okay, the smaller funds, the large funds, they're also on the retail. The smaller investment banks, they're also on the retail. Okay, because you're no different than you. They also trade the same way because you're trend following. Only difference is their money management skills is better than what you have. Okay, but their style of trading is no different than what you know. Okay, you're also trading the textbooks. What the textbook teaches, that's what everyone's trading. So ideas like this is bound to create a pooling of one-sided liquidity because everyone's looking almost at the same thing in price. So I have liquidity being injected and being neutralized. So the process of the market turning up into a level of open flow liquidity is what we call neutralizing open flow liquidity. Okay, neutralizing open flow liquidity is the process of the market running up into current open flow liquidity. Now let's talk about neutralizing pending flow liquidity. Or, sorry, let's talk about pools of liquidity, and we're going to go into neutralizing pending flow liquidity. Pools of liquidity is essentially what I stated before, where at short-term highs, just going to be buy stops. At short-term lows, just going to be sell stops. Okay? So those pooling of liquidity is as a result of market participant interpretation of price that causes them to take a bet on one side of the marketplace, and the collective action of individuals taking action based off of market information is what creates the pooling of liquidity. Just like this idea of a top is sold to retail, and this idea of a double bottom is sold to retail, that creates a pooling of liquidity there. Okay, so the liquidity resting above a short-term high, that is buy-side liquidity. The liquidity resting below a short-term low, that is sell-side liquidity. Going back to the initial explanation I did of what buy-side liquidity is and sell-side liquidity is, the pooling of buy-side liquidity is a combination of both buyers who are wanting to buy above the short-term high and sellers inside the range with protective stops above that short-term high. That collectively creates a pooling of buy side, and then you just invert the concept for the sell side. Now when it comes to neutralizing pending float liquidity, we're going to go into a recent example on euro dollar, and that was from yesterday, which we traded. We actually traded this in the live session yesterday. Neutralizing pending liquidity is when the market rapidly sweeps both sides of the marketplace in price. Typically, when the market is in consolidation like this, there will be a build-up of pending liquidity. What are the pending liquidity? Individuals want to buy the breakout of the range higher, go back a little bit. Okay, I think we're good. This is so there's individuals who want to buy the breakout of the range because that's how they teach trading consolidations. Buy the breakout higher, sell the breakout lower. So the process of the market being in a range creates pending float liquidity, not open float liquidity, because those liquidity are not in play yet in the marketplace. Remember, open float liquidity is the liquidity currently in play in the marketplace. In this example, the liquidity is not yet in play in the marketplace. Okay, they are pending, meaning they're transactions that will be triggered when the market gets to those level. So we have a pooling of sell side liquidity here. Then we have a pooling of buy side in form of buy stops, and then the sell side is in form of sell stops. So we have pooling of liquidity in form of buy stops. So let's just use buy stops and sell stops. Okay. So retail will want to short the breakout of the low. You can have their stops here. Now think, if they have their stops here, the pending sell stops here, when the market is on there, what order would that be? That is going to be a market execution to sell the market short at that price. Where you're going to put your stops? You're going to put your stops at the high of the range. So that creates pending buy stops. That also adds to all the buys up here want to buy the breakout. If the buys up here want to buy the breakout, where will they place their stops? It's going to be below the marketplace, which then adds to the sell stops. You see how they complement one another? Okay, they're complementing each other. So what happens next is the market will aggressively run the buy side. Now, what do you think is going on here? The pending float liquidity becomes open float liquidity. So now open float liquidity of the buy stops are in play. And we have pending float liquidity of the sell stops. That pending float liquidity of the sell stops are in form of willing sellers of the breakout down here, and also the protective stops of the buyers who are now open flow liquidity up here. So we have them down here. They look at what the market does next. Aggressively runs lower. Now what happens here? Buy stops are now neutralized. Sell stops are now in place. Now we have open float liquidity on the buy side, not the sell side. Why? Because we've activated the sell stops here. We've neutralized sell stops. Now we have buy stops up here. Okay. If you're selling here, where you're going to put your stops? Above the high that was just recently created. And that's what the market does next. And the market runs aggressively again for the buy stops up here. Okay. So what we had there prior to the spike lower was pending float liquidity. The moment the market ran higher, initially we had open float liquidity of the buy side with pending float liquidity of the sell side. And then we neutralized sell side liquidity. Okay, so any buyers up here, your stops are neutralized. Any sellers down here, they're now in the game. They're activated. Now the market is going to aggressively run for the pending float liquidity of the sellers down here in front of the buy side. That's what happens up there. So neutralizing pending float liquidity is when the market swoops past intraday highs and lows and rapidly activates pending float liquidity on both sides of the market and stopping them out via whipsaws. If you try to trade continuation patterns in ranges like this, you are bound to lose money, definitely. Which is what one of you guys actually did on Twitter and also on Discord. I was warning you guys about that. I was teaching you guys why you're not supposed to trade continuation patterns in ranges like this. Okay, you would have seen my execution. I was selling the breakout of the consolidation, and I was buying down here. Okay, you can check that in real time. So let's go on Twitter and go to Twitter, and you can see my order there. So let's go to media, and you would see the recording of my order. Can I make this larger? Okay, I can. Alright, so you can see me taking a sell on Eurodollar as we're broke out of that consolidation. And you can see I'm shorting the run higher. I'm shorting up here. I'm adding more size into my position. I'm waiting for the release because I know at the release the market is going to run aggressively for the sell stops of all the people who are buying the breakout. So as the retail buys the breakout, I am selling against them, just like the institutions would. I'm selling against them, anticipating that the algo at the news release should drive price against all the stops of the buyers up here and all the willing sellers down there. You can see the outcome of my trade. Let's see. You can see the outcome of the trade. Okay, the sells, the out of the market runs aggressively for the sell stops, and I took profits there, and I left the remaining portion on, which got stopped out eventually. Okay, so that is neutralizing penny flow liquidity. And engineered liquidity essentially is the same as essentially that's what's going on here. So as the market is in a range, liquidity is being engineered in price, and the market would then run into those liquidity to then clear out stops. Controlling the board is actually a different topic. So that is for relative strength, which we're going to talk about. So this is outside liquidity. I'm going to bring this back into play when we go into relative strength and how consolidation on the majors impacts price delivery on the crosses and the relationship between them. I thought I corrected this. It's double E, not Alright, so that is that. Now let's go into internal liquidity versus external liquidity. Before I go into internal liquidity versus external liquidity, what PD areas are we concerned with when dealing with liquidity? Rejection blocks and old highs and lows. Now, if I'm buying to a short-term high, my first objective always is going to be the rejection block of that short-term high. That's how I start to scale out partials. So going back to into our initial example on Bitcoin, where was the example? That was this. Okay. If I was buying down here and I was buying to return back down into our initial range of price delivery. So we have a order block, volume balance there. Look at that small little volume balance there, which we'll return down into. If I was buying there and I'm targeting this high, understand that retail, you're going to be just gonna be a lot of willing buyers up here. I'm targeting that high. I'm going to scale out something at a rejection block, because a lot of times the market could trade up into a rejection block and trade lower. That is enough to send the market lower. That can happen a lot of times. But if we go and look at price action, I bet you're gonna see that oftentimes. So look at this, for example. We have a rejection block here. Oh, sorry. We have a rejection block down there. And then we have the old low there. Our sell side liquidity pool starts from the rejection block and extends through the old low. It's not just that old low there. Now, if we let's assume you shorted a return back up into this bear shorter block. Let's say you shorted that, and you're targeting the sell side liquidity pool rested on here, and your stop was above the order block. If you did not scale out any partials at the rejection block and you're waiting for the market to trade through that old low, you are not booking any profits. You're either getting stopped out at a loss, or if you move your stops to break even, you're getting stopped out at break even. You're not booking any profits. If you took some profits off at your rejection block, then you booked something. Even if you got stopped out eventually, you still booked something. So whenever you're targeting a pool of liquidity, always target the rejection blocks first before aiming for the short-term high or low. Because a lot of times, you're going to be tons of times where the market trades out into rejection block, offered you money, but you left money on the table because you were unwilling to take something off at a rejection block. You're waiting for that old low or that old high. Now, why are rejection blocks important in form of liquidity? Because on the interbank level, bodies of the candle are where the bulk of volume of transactions are done. So to interbank traders or to fund, they're more concerned with where the bulk of transactions is done, which is the candlestick bodies. Okay, so if the market trades down to that candlestick body, that is a sensitive PDA rate, and that's something we'll discuss on the institutional reference fund videos. Okay, so when dealing with liquidity, classic liquidity, I'm going to teach you more advanced liquidity. I think that's a separate video entirely. So when we're dealing with classic liquidity, we're dealing with rejection blocks and old highs or lows. So we're dealing with bullish rejection blocks, bearish rejection blocks, and old highs and lows. On the next lesson, we're going to talk about internal versus external liquidity. That is going to be a shorter video. I don't want to make this long so you don't get bored having to go through over an hour of content and then trying to grasp and understand. So the next video is going to be part 2 and the final video on liquidity pools and liquidity runs, and we're going to discuss high resistance liquidity run, low resistance liquidity run, internal liquidity, and external liquidity. With that being said, you guys will have an awesome evening, and I will see you guys all on the next video. Trade safe.